They said it wouldn't happen. I'm your host, Steve Van Metre, and thanks for joining me today. And following the pandemic, government officials and policymakers said that we were going to see an economic boom unlike anything we've experienced in decades. And yet in our lead story today, we've got a data series that has crashed the most on record, which shouldn't be happening. And as we look at data and go around the world, we're going to close out with the U.S. data, and you're either going to have one of two conclusions. Either the U.S. economy is indeed bottoming, or we are on the cusp of what looks like the beginning of another financial crisis. When we get to the charts, I'll let you be the judge. But for now, let's head over to CNBC, where we pick our headline story up with South Korea posts the worst trade deficit in history. And now when you think about why trade matters, we talk about, things like currencies. When it comes to trade and debt, you need to see an expansion. So if you're seeing debt expand, you're seeing trade expand, you're seeing demand for currency, these are all good things. But when you start to see trade deficits collapse, it tells you there's something seriously wrong in the global economy. And perhaps the U.S. part of the world just hasn't seen it yet. January exports fell 46.3 billion, or a whopping 16.6%, declining more than expectations. Imports, not as important of what we're going to focus on today's show, fell 59 billion, or 2.6%. That resulted in a deficit of 12.7 billion for January, more than the 9.27 billion expected by economists. And so when you think about why this matters, why would we even care about what's going on in South Korea? It's because they're a major export nation. And so who is the major import nation of the world? That's right, that's us, that's the U.S. So when you see exports coming out of a country collapse, well, what does that tell us where imports are headed in the U.S.? What does that tell us about demand? It tells us it's plummeting, and this chart verifies it. And here you can see South Korea's trade balance just completely collapsing. We note that coming out of the pandemic, it surged. Of course, this was all due to pandemic-related fiscal and monetary stimulus that greased the global economy. Now we don't have that anymore. And what we thought was going to happen, or what we were told was going to happen, is yes, there would be a slowdown, but this is just the beginning. Well, my friends, this does not look like a slowdown. This looks like an outright crash. The widening trade deficit seen in January, and I want you to see how they're spinning this, is widely seen due to seasonal factors such as an import in energy exports for the winter, as well as a sudden drop in chip prices, leading to a worsened picture. And now, again, we talk about the spin on this. What the reality is demand is crashing. And we have further evidence as we now head over to Singapore, another major export country. Let's look at the data here because we get a little more detail, and you're going to see that this one-off report in South Korea isn't a one-off report at all. Singapore posts worst non-oil domestic exports in a decade. Singapore's non-oil domestic exports plunged 25% a year on year in January, their largest drop in 10 years, which is huge. Government data showed Singapore's non-oil exports to its top markets led to wider decline, with exports to China falling by more than 41%. But get this, to the U.S. by 31.5%. So here you see China, who pulls a lot out of Singapore, and now you have the U.S. Obviously, we are a big trading partner with them as well. When you see collapses at that magnitude, 31%, 40%, this is a serious sign of an outright decline in demand. This isn't anything else but just that. And so when you start looking at the global economy now, what have we been told? What have we been told? That, hey, maybe there's a bottom here and this is going to turn higher. We hear other people saying recession in the second half of the year. What we're starting to see in the data, that perhaps we're going to see a recession much sooner than everyone expects. The reading marks a fourth consecutive contraction and the steepest fall since February 2013, when the economy saw more than a 30% decline. And here you can see their non-oil exports. Look at what we see here coming into what would be the great financial crisis, notably how their oil exports were non-oil exports were collapsing. You see it happening again. You see it happen going into what was believed to be a global recession that didn't happen. But now when you see this data series, you have to admit it's ugly. as tumbling export earnings are also likely to weigh on domestic demand, stalling business investment and employment growth. So you think about it from these exporting nations' perspective. So we've been kind of focused right now and saying, look, demand from the U.S. is collapsing, but what does this mean for those countries? Well, if demand is falling, what do they need less of? That's right, they need less workers to create these products to sell in foreign markets, and that's going to lead to more unemployment and what could then be the catalyst for the next global recession. And if you're worried about this, as we talk about the dollar, now many of you found the coupon code. I noticed that. I added just a few more, so those who missed the Friday show, it's in the description below. But as we talk about the dollar here in the second half of the show, I want you to note that this was showing 100% short position on the algorithms not too long ago, and I want you to see how fast this report picked up that move. And if you're long the metals, you can see due to the rise in the dollar, it's bringing that down. And again, there's a $10 off coupon bringing that the $30 price to $20. Link in the description below. The coupon code is 10 off if you can't find that, but it's all there for you. So now let's shift to the US, because the first part of this story is going to say, hey, maybe things aren't as bad as we think, but I'm going to show you why, what the real catalyst here, and then we're going to go to one day later, a different piece of data out of the US, which gives us a completely different picture, and I'm going to show you some charts that may give you the indication that we are indeed heading into the next crisis. New York State manufacturing activity shrinks less than forecast as the Federal Reserve Bank of New York's General Business Conditions Index increased by more than 27 points to minus 5.8 this month. A reading below zero indicates a contraction. So here's what you're seeing. So I'm going to give you a couple different looks at this. Then one of them is that, hey, we're still slowing, but the rate of that slowdown is now less. The other way you can look at it is, hey, we've bottomed out. And yes, we're still slowing, but we're slowing at such a small rate now that the next move is for this thing to turn higher and see the manufacturing sector, at least out of New York, move back into an expansion, thus validating, at least if your view is that the economy has already kind of bottomed out, that this report would give you an idea that we're close to seeing that happen. The gauge has shown a contraction in 6 of the last 7 months, underscoring the number of headwinds faced by the manufacturing sector as the Fed raises interest rates to combat inflation, which we will, of course, completely disagree with that last statement, and I'll give you a reason why when you get to those charts. The survey showed increases in the measure of prices paid and received by the state's manufacturers, indicating that while inflationary pressures are cooling, they remain stubborn. The index of prices received reached a 6-month high. So this would be good news. It would actually be telling you that consumers are now able to afford these higher prices. They're being pushed through the supply chain. So you're seeing when this report says, hey, maybe things aren't that bad. In fact, maybe we're coming out of a bottom here. In fact, new orders even increased more than 23 points to minus 7.8 in February. Still a fourth straight month of contraction, but still showing it's getting a little bit better. At the same time, the Fed Bank's manufacturing outlook improved somewhat as the future index, the expectations moved to 14.7, the highest since May. So you see all of a sudden out of New York, you see all this good news in terms of, hey, we're probably bottoming out here and things are resuming as normal. But then you look over to South Korea and Singapore and you say, well, wait a minute, that doesn't make a lot of sense. Is there something here that we're missing? Well, hang on to that. But now let's go to the next report, which shows that maybe things aren't as rosy as the New York report suggested. Philly Fed unexpectedly tumbles to a recessionary 21-month low one day after the Empire State Survey surprised by surging from a post-COVID low to minus 32.9 to minus 5.8 as we just looked at, which was one of the biggest monthly increases on record. The Philly Fed surprised, well, to the downside. And whether it's a bitter Super Bowl hangover or just something going on in New York, the Philly Fed reported that its business outlook plunged from minus 8.9, so again, a contraction to a recessionary minus 24.3, beating expectations to the downside, and a 6th consecutive negative reading, and the lowest reading since May of 2020. So here you have a completely different picture. And now let's look at a chart of the two overlaid, because what we're going to see is the New York survey is just far more volatile than the Philly survey, as we have the Philly survey in red, which of course they're both volatile, but we note that the New York survey has been all over the maps here. And if the Philly survey is right, well, the New York survey is going to take a major downturn next month. Looking closer at the Philly survey before we get to those charts, I want you to see here we see that recessionary print minus 24.3 as general business activity is plummeting. And what I want you to note is when we look at the employment here, we're not going to see a big move there. But if business activity continues to plummet, they're going to be forced to lay off. Once the layoffs begin, there's no way this economy recovers. Here we can see the employment data. Average work week fell just around 3.2 points, not much. Employees actually increased. But look at here, prices paid. The number of firms were able to get higher, were paying higher prices went up, but the prices received, unlike the New York data, well, not as many firms were able to pass those through. New orders further collapsing again. So now let's look at this chart and try to answer the question is, maybe there's something else in the data that the articles weren't pointing out, and I think one of those is the dollar. So let's look at the nominal broad dollar US index in red against the general current activity. We don't have the New York Fed data, but we do have the Philly data here. And what I want you to note is when the dollar is decreasing in a longer term trend, it generally means the business activity goes up. And when you see the dollar rising, it tends to put a slowdown on it. And when it goes really fast up, you can see business activity falls. But again, you see the dollar declining, you see business activity holds up, dollar declines, business activity stays up. Here's the dollar's declining. That could be what's being priced into the New York Empire survey. But now there's something on this chart I want to go back here and look at that maybe is an ominous sign of what is to come. And what we can see is there's periods when you see going into the financial crisis where business activity is slowing down. So we see that trend here, and the dollar is weakening, and the dollar is weakening here, and it doesn't do much for business activity. And what that's suggesting is the global economy is slowing down. That's what it meant back then. And the reason the dollar went down is because there wasn't as much demand. When you don't have a lot of global trade, well, you don't need a lot of demand for dollars, and you see both of them go down together. If that is happening again now, well, that is the warning. The global economy is indeed in dire shape. And what does it mean for inflation? Of course, we look at prices paid, which you'll notice the article said, hey, they're going up a little bit, but the overall trend you see in blue coming out of the Philly Fed is prices paid are headed lower on the diffusion index. That means the CPI comes down, and all of it tells us is demand for the global economy is perhaps far worse than we thought. And if this plays out, a second half recession is not just baked in the cake, it's now a near certainty. The only question I have for you is, do you think it comes even sooner? I'll let you weigh in the comments. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.